It is important to understand the difference between gross and net profit. Knowing the gross profit margin, net profit margin, and average rate of return is essential when making business decisions. Why are profit calculations limited? Profit calculations alone are of limited use. While gross profit can be compared over time to see whether products have become more or less profitable, additional information is needed to assess whether a business has performed well. What can be done to better assess the performance of a business? In order to better assess the performance of a business, it is necessary to calculate the profit margin. Profit margin is the amount of profit expressed as a percentage of sales revenue. Since there are two different measures of profit, there are also two different types of profit margin: gross profit margin and net profit margin. Gross profit margin. What is gross profit margin? The gross profit margin is the percentage of sales revenue that is left once the cost of sales has been paid. It tells a business how much gross profit is made for every pound of sales revenue received. For example, a gross profit margin of 75 means that every pound of sales provides 75 pence of gross profit, where a business is able to provide significant added value. Then the gross profit margin will be higher. Examples include handmade goods and specialist services. Using the gross profit margin. How can you use the gross profit margin? Comparing gross profit margins over time can be useful for businesses. In the example above, the gross profit margin decreased despite the fact that the sales revenue tripled and gross profit doubled. This indicates that the cost of sales, which includes raw materials, increased faster than the business increased the price it charged its customers. This business might respond by increasing the price that it charges its customers, or by negotiating lower prices for raw materials with its suppliers.